Hey, what's up, my friend? So, in today's training, it's all about multiple time frame secrets. So, here's what we'll talk about, right? First thing first, stack levels. How do you identify high probability market turning points, right, with deadly precision? Number two, we'll talk about the rubber band effect. How do you avoid low quality trading setups, right, that mask themselves as high probability trading setups? This is something that fool, right, many traders because they think that, oh, this particular trading setup, it looks bullish, right, it's a high probability trade. But in fact, right, if you dig deeper, if you understand multiple time frame analysis, you realize that those setups are crap and you want to avoid it. And number three, how to improve your winning rate instantly by using this one simple technique. So all this and more, right, in today's trading. First thing first, mistakes to avoid when using multiple time frames, right? So the first mistake I want you to avoid is, what I notice is that traders, they zoom out their charts too little till it becomes, meaningless, right? For example, let's say you trade off the 5 minutes time frame and you use multiple time frame analysis, you go up a higher time frame like the 10 minutes time frame. To me, that's useless. That's irrelevant, because on the 10 minutes and the 5 minutes time frame, you'll see that the information you get is somewhat similar. You don't gain any new information, right, just by going up from a 5 minutes to a 10 minutes time frame. So that's the first mistake, right? You zoom out of your charts, right? Or rather, you go up a higher time frame, right? But it's not significant enough, right, to give you any new information for your own trading. Number two, you zoom out too much. So this is where you overkill things. So for example, let's say again you trade on the 5 minutes time frame and you zoom out to the monthly time frame. That is overkill, because whatever happens on the monthly time frame is irrelevant, right, to a trader on the 5 minutes time frame. That is something like, let's say you are at your house, right? You own a piece of land and you want to know next door, right, what's your neighbor doing? Something is noisy down there. You're curious, but you're blocked by a fence. So what do? By right? You just take a ladder, climb the ladder, and you can see what your neighbor is doing. But when you zoom out too much, right, that is like, going into space and look down and see what your neighbor is doing. That is overkill, and that's what I mean by, zooming out too much. So when you use multiple time frame analysis, there is a sweet spot to it. You cannot zoom out too little, and at the same time, you cannot zoom out too much because it becomes overkill. So what is the sweet spot? Right, but before I get to that, right, if this is the first time you're watching my trading video, right, give me a thumbs up, subscribe to my YouTube channel. This way, whenever I publish a new video, you'll always be updated. So do it right now, hit subscribe. And moving on, the first secret is this, is that when you use multiple time frame analysis, you want to use a factor of 4 to 6. This is something that I believe it's mentioned by Alexander Elder or even Adam Grimes, right? So this is a technique that I learned from them. So let's say, for example, again, you are, let's say, higher time frame between a factor of 4 to 6. What do I mean by that is, for example, let's say we go with a factor of 4. Let's say you're trading on a 1 hour time frame, right? Let's say you're trading on a 1 hour time frame. Your higher time frame should be the 4 hour time frame. How do you get 4 hour time frame? You just take a factor of 4, multiply by this 1 hour, you get 4 hour time frame. Okay, so let's try a factor of 6. Let's say your trading time frame is the 5 minutes time frame. And what is your higher time frame? If you are using a factor of 6, you just take 6, multiply by 5, you get 30 minutes. And the 30 minutes time frame is your higher time frame. Okay, so this is a very useful technique to use, right, to define, right, what is your higher time frame. So let me give you another quick one. Let's say you're going with a factor of 5. Okay, and let's say your trading time frame is the 2 hour time frame. A factor of 5, your trading time frame is the 2 hour time frame. So what is your higher time frame? Right, do this quick exercise with me. The answer should be, your higher time frame should be a 10-hour time frame. Okay, I hope you got that one right. So that's the first secret, right? Whenever you use multiple time frame analysis, whenever you want to define your higher time frame, remember this factor of 4 to 6. Anywhere between 4 to 6 is fine, or even 3 to 5, it's perfectly fine, right? Don't get too anal about it, right? Okay, so just remember this range. Secret number 2, right? Stack levels, right? So what is stack level? So let me ask you a question. So let's say, Valentine's Day. Right? I'm sure your wife, your girlfriend, right? They do appreciate that day, right? They want to be, loved on that day. So that's the first scenario. Let's say the second scenario is this. Valentine's Day again, but this time around, Valentine's Day happened to be your wife's birthday. And on top of it, right, it's the same day, right, that the two of you got married. In other words, it's your wedding anniversary. Now let me ask you, which scenario, right, is Valentine's Day more significant? Is it the first scenario where Valentine's Day is just Valentine's Day for everyone? Or is it in scenario 2 where Valentine's Day is your wife's birthday and your wedding anniversary? Which one is more significant? Well, probably scenario 2, right? Because we have a multiple of a confluence of events coming together on that same day, and that day becomes more significant, right? Although I know the truth is because you want to be a cheapskate and don't want to buy too many gifts, so all on one day, that's a pretty smart idea, right? But let's not let your wife know that. But so you can agree that Valentine's Day, in the second scenario where we have a multiple confluence of events, makes that occasion much more meaningful, more significant. And why am I sharing this with you? Because this is the same as trading, right? Let's say you identify a level on the daily time frame, and if that level, right, has a confluence of let's say also a weekly level, same level, it becomes more significant. Let me just explain to you what I mean by this, right? Look at this chart over here. Okay, so I'm going to looking over here, right? Why did this market? Okay, let me just get out the tool, right? Why did it reverse at this particular level? Well, some of you might look at this chart. Oh, Rayner, that's because there is an area of resistance over here, right? Fair enough. There is an area of resistance over here, which I draw over here. Okay, but there's also another one over here and over here. So what makes this one special? Well, again, remember, multiple time frame analysis. If I go up to the higher time frame, like the daily time frame, from the 4 hour to the daily is a factor of 6. You can see on the higher time frame, this particular level over here. Okay, let me just point out this level that you've seen earlier on the 4 hour time frame has a confluence of this one over here on the higher time frame, the higher time frame, and about here as well. So you can see that on the higher time frame, the daily time frame, this level is a significant level. So the 4 hour level has a confluence with the daily level, and that becomes a stack level. So let me just put this down side by side so you can see where I'm coming from, right? Let me just split up the charts. Okay, so on the daily time frame, this portion over here. Okay, so now you can see over here the daily time frame, this level over here is the same level that you see over here. It's the same level. So now do you see the significance of this? This level now is no longer just a 4 hour time frame resistance. It's also a daily level, right? A daily area of significance, right? So this is how you use a stack levels, right? When you're using your multiple time frame analysis. If you identify a level that is a confluence of a higher time frame level at the same spot, at the same area, that level becomes significant. Another example. Okay, let's look at another example. Okay, so let's say we look at this one over here. Now, you look at this daily time frame. Okay, right, price, you may look at this. Oh, why did price reverse at this level? Maybe it's because there's this swing, this area of support over here. That could be one possibility, right? Why the price reversed at around this area. But again, if you use multiple time frame analysis, if you understand multiple time frame analysis, let's say we go up with a factor of 5, the weekly time frame. You look up, you notice that level, it's actually a significant level on the higher time frame. Over here, 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 and here. It's tested once, twice, thrice, 4, 5, 6, 7, and here the 8th time. So now, this level no longer is just a daily time frame level. It's a level, right, that can also be seen on the weekly time frame. So my point here is this, right? When you are trading using multiple time frames, right, you want to be aware of the levels that you have on your chart, the areas on your chart, because those areas that has a confluence of a higher time frame level or area as well, those levels are really the ones, right, that you want to be trading off. Those are the ones, right, that has a higher probability of reversal. Make sense? Okay, so if I just going to align this, right, side by side again. Okay, so this one over here, okay, this is the weekly time frame. You can see the weekly time frame, and over here is the daily time frame. Weekly time frame is this level here, here, and here, which comes into confluence on this level here on the daily time frame. So now this level on the daily time frame here becomes more significant when you look at the big picture and you realize, man, that level is actually a weekly level. That's why, the price reacted near that area. Okay, so that's the first thing that rather it's the second thing, the second secret that I want to share with you, right? Remember this Valentine's Day analogy. The third thing, the third secret, the rubber band stretch. So when you understand multiple time frame analysis, right, you will know, right, when to buy and when to sell. You don't want to be buying, right, when the price is far away from the area of value on the higher time frame. I know that sounds pretty darn confusing. So let me just fire an example here to show you what I mean, right? So if you look at this this chart over here again. Right, they'll look at this chart and they would think that, man, I should be... They'll look at this price breakdown of this swing low. Oh man, I should be selling, right? Look at this, Rayner. The market is in a downtrend. It just broke the swing low. The trend is about to continue. Let's sell, sell, sell. To be honest, right, this is what I used to do, right? Until I found out the mistake that I did, right? And this mistake, this revelation came, right, only when I understand multiple time frame analysis. So again, let's look at the big picture, right? So daily time frame, we can use the weekly as our higher time frame, right, as a guide. So if you look at the weekly time frame, okay, and let's identify the area of value on this chart. So what you can do is, use tools like trend line, moving average, whatsoever, whichever you like, right? So in this case, I'll just go with trend line. Okay, over here, Control C, Control V, and I realize I can actually draw a channel. So what you realize over here is that when you were selling earlier on a daily time frame, you were actually selling near the lows of this trend channel. Is this an area of value? If you think about this, right, you know that the market has been contained in this trend channel. If you want to sell, you want to be selling near the upper channel. And possibly, right, taking profits near the lows, right, of this channel. You don't want to be selling at the lows of this channel because that is possibly, right, one of the worst areas, right, you can look to short the market. But again, right, you won't know this, right, if you don't understand multiple time frame analysis. So if we go back earlier to the daily time frame, there you see over here, okay, so this is the weekly time frame. On the daily time frame that you see over here, okay, I just put it side by side. You can see that over here when you're selling at this point, right, is where you are selling here on the weekly time frame, near the lows of the trend channel, near, right, where buying pressure is about to step in and push the price higher. So can you see this this significance over here? Right, when you understand multiple time frame analysis, right, it gives you an X-ray vision. It gives you a bird's eye view, right, of what you're doing in the markets, right? Are you buying into an area of resistance? Are you selling into an area of support? Right, this is important stuff. Let me give you one more example. This time around, we use a different tool to define your area of value. So if you look at the 5-year Treasury note futures, okay. Over here, again, same thing, right? If you look at this chart, many traders, they'll look at this. Oh, Rayner, look at this, Rayner. Higher lows, higher highs. Market is in an uptrend. There's this consolidation here, Rayner. Let's buy the breakout. Do you want to do that? I hope not, right? Because you want to see where you are in the grand scheme of things. You want to know where you are in the big picture. So let's again use multiple time frame analysis. How can we do that? So this is a 4-hour time frame. I usually like to use a factor of 6. So the higher time frame to me is the daily time frame. So let's look at the daily time frame and see where we are. So earlier that point, right, where you were buying, you were actually buying at this point over here on the daily time frame. You're buying somewhere here, about here. And when you look at this, right, do you want to be buying at this highs on the daily time frame? Because if you take a step back and you look, right, you notice that the price tends to respect the 50-period moving average over here, here, here. And you know that the 50-period moving average is an area of value for this market. So you clearly don't want to be buying near these highs because if the market does a pullback, you likely get stopped out. You'll most probably get stopped out. So again, let's lay the chart side by side and see what you're actually doing on a 4-hour time frame in the grand scheme of things. Okay, so lay out side by side. So this one here is the daily time frame, the 4-hour time frame. Okay, you can see it's over here. So I lay out side by side. You see over here, right? So what you did earlier is that on a daily time frame, you're buying near this highs over here. Okay, on the 4-hour time frame, it's at this point over here. So if on the 4-hour time frame, right, you're not aware of multiple time frame analysis, right? You just blindly buy, right? Then you will probably get stopped out on this pullback, this decline over here. But if you're a trader who is well versed with multiple time frame analysis, you might hold your horses and might say, okay, I don't want to be buying at this highs because the price now is overstretched away from the area of value. I might want to wait for the price to come to my area of value, to come to me, right, before I look to enter a trade. Okay, so this is what multiple time frame analysis can do for you when you understand, how the big picture works. So moving on. Secret number 4, how do you actually improve your winning rate using multiple time frame analysis, right? So the thing that I want you to pay attention to is look for a break of structure in the direction of the higher time frame trend. Again, this one sentence is not clear, right? So this is why I like to give examples, right, to illustrate my concept. And often, right, traders might say, "Hey, Rayner, why are you, cherry picking all these charts? All this, right? It's all on hindsight." Yes, it's all on hindsight, and yes, I cherry pick these charts to illustrate my concepts. But I'm not expecting you to blindly trade them. I expect you to test, verify the concepts that I shared with you, and whether it works or not. This is not no spoon feeding you and tell you, "Oh, this is the way to do things, right? You must do it this way." No, this is to open up your mind, your horizon, to be like water, my friend, and to see that there are different ways to trade the market, different concepts that might resonate with you. And if you think it resonates with you, go apply it, test it out, and see if it works for yourself, right? Don't just blindly take my word for it, right? This is important. And okay, moving on. Break of structure, right? So let's have a look. So if you look at this market, right, the pound yen, and on the daily time frame, okay, daily time frame, you notice that the price has come into this area of a resistance. And you're wondering, right, often traders, when they trade support resistance, they look for common candlestick patterns like shooting star, hammer, engulfing pattern, so on and so forth. And that is perfectly fine. But what if the market doesn't form this textbook patterns that you're familiar with? What if you don't get these type of patterns? What now? Do you just forego the trade? Just let it go? No, right? Because if you understand multiple time frame analysis, you realize that you can actually time your entries without candlestick patterns. The only thing you need to know is understand market structure, and it's really simple. And I'm going to explain to you how this works. So again, right, on the pound yen, you see that price now is at this area of resistance, right? This was previous support, which become resistance. Great. So what's our entry trigger? How do we enter the trade? There is no, price rejection. There is no bearish engulfing pattern, blah, blah, blah. Let's assume there isn't, right? So what you can do is, again, use multiple time frame analysis. This time around, we go down to the 4-hour time frame. This is a factor of 6. And you see over here that on the 4-hour time frame, you have this. So this is how the 4-hour time frame looks like. Again, if I overlay the chart side by side, right, you get to see it better. So on the daily time frame, this is the level that we saw earlier, okay? On the 4-hour time frame, it looks like this. And the break of structure is very simple. At this point, right, you notice that there is a series of higher highs and higher lows coming into this area of resistance, right? Higher lows, higher highs. Pretty simple stuff. So a break of structure means, right, what you're looking for is a break of this prevailing price structure. You're looking for a lower high and lower low. So where did that happen, right? So the lower high and lower low occurred at this point, right? At this point, you have a lower high and a lower low. When the price break below this low, you now have a lower high and a lower low. And this is what I call a break of structure. And this is not an ordinary break of structure, because this is the break of structure at a key area on the daily time frame, in line with the overall trend on the higher time frame, which is the daily. You saw earlier that on the daily time frame, it's in a downtrend, right? You see over here, this is in a downtrend. So this, right, this break of structure technique, right, allows you to better time your entries, align, right, with the higher time frame trend, align with the higher time frame resistance area. Make sense? Okay, so this is what I mean by a break of structure. So let's look at one more example. Okay, over here, this is the dollar against the Norwegian chrono reset chart. Quick one. Let's look at the daily time frame. So again, daily time frame, you saw that, or rather, let's look at the weekly time frame. You saw that earlier on the weekly time frame, price, right, is at this significant area, right? Previous resistance becomes support. And again, let's say you don't have any price patterns to enter a trade. What can you do about it? Well, you can use multiple time frame analysis. You can look for a break of structure technique. So going down to a lower time frame, a factor of 5 is a daily. You're now looking for a break of structure. So you can see that the price came down lower here, and it bounces up. Then it pulls back. When the price breaks above this high, what do you have over here? Higher high and higher low, right? And on top of it, you're leaning against this area of support on the weekly time frame. And on top of it, you saw that earlier on the higher time frame, the weekly time frame, it's in an overall uptrend, right? Let me show you this overall uptrend on the weekly time frame. There you have it. Okay, this is the weekly time frame, and this is the daily time frame. So can you see the significance of this break of structure technique? using multiple time frame analysis. You don't have to rely on candlestick patterns, right? You don't have to rely on price rejections. If you understand multiple time frame analysis, you can go down to a lower time frame to better time your entry. And also, another thing is this: on the weekly time frame, right? Most traders, how they will trade is like, let's say, there's a higher close over here. They will set their stop loss, right? Let's say below this lows or 1 ATR below it somewhere here. It's a pretty decent stop loss. But if you understand multiple time frame analysis, you can actually reduce the size of your stops, because now your stop loss can be based on the market structure on the lower time frame. Let me show you. So on the daily time frame now, when the price broke above these highs, you can reference this new swing low to set your stop loss. Your stop loss now is tighter. A tighter stop loss offers you a more favorable risk to reward on your trade, right? This is powerful stuff, right? It is all because of you understanding multiple time frame analysis. Okay, so with that said, right, let's do a quick recap, right? Number one, when you want to use multiple time frames in your trading, right, adopt a factor of 4 to 6 to define your higher time frame. Number two, remember the stack levels, right? When there's a confluence of when a level, right, is significant also on the higher time frame, right, that level becomes even more significant, right, and it has a higher probability of reversal at that area. Number three, don't buy when the price is overstretched on the higher time frame, when the price is far away from the area of value. And number four, if you want to increase your winning rate, right, trade the break of structure in the direction of the higher time frame trend. Okay, so I hope this helps. And if you want to learn more, right, if you enjoy today's trading, right, I have this complimentary trading guide for you. Go and download it. It's free. The ultimate guide to price action trading. You'll learn how to better time your entries and exits. We talk about support, resistance, market structure, and so much more. So click this orange button, right, and I'll send it to your email for free. And if you've enjoyed today's trading, give me a thumbs up. Subscribe to my YouTube channel. The link is below, and I will talk to you soon.